Money. It's not the most important thing in life, but it is important. You need money to do just about anything. So basically, the more you have, the better off you'll be. It's that simple. The challenge is how to get it from here into your pocket. And one of the best ways of doing that is by investing. Okay, I know some of you might be a little apprehensive about investing. You may think you don't have the kind of money it takes, or that it's way too complicated. But the more you learn about investing, the more you'll see that it's not all that difficult. And you'll realize that it's an important way for people just like you to build wealth, whether it's for an education, a new home, a vacation, or your retirement. So if you want to put more money in your pocket, why not consider investing? All right, it's a fact that in the world of investing, you need money to make money, but it doesn't have to involve huge sums of the stuff. There are a lot of ways that someone like yourself can earn more by investing, but on the other hand, there are just as many ways you can lose it. That's why it's important to know which types of investments are right for you. After all, you can't depend on winning the lottery to help build your wealth. So the next best thing is to play bingo. No, I'm just kidding. Sorry about that. The next best thing, really, I'm being serious this time, is to know how to make money with the money you've already got, and that's done through investing. But again, it's important to realize that you don't need to have a lot of cash on hand to make investments. However, to be successful at it, there are some important points you need to be aware of. But that doesn't mean that investing has to be complicated or risky. Chances are that you are already an investor. A certificate of deposit at the local bank, a 401k retirement plan at work, even a collection of vintage comic books. They're all considered to be investments, but each one has different characteristics that set it apart from the others. Now, these traits include the concept of risk and reward. You know, the higher the risk, the greater the potential reward, and vice versa. Investment size is another characteristic. It relates to how much money is needed to invest in something. Sometimes a lot is needed, other times it's just a small amount. Liquidity has to do with how easy it is to convert an investment into cash. It also reflects how costly it is to do that. Attention is an important characteristic since some investments require a lot of it, while others don't. Duration relates to the length of time that an investment should be held on to. Now, this depends on the type of investment, along with the reason why it's being made. Stocks, for example, are usually considered as being a long-term investment, while a CD can mature in as little as 6 months. Investment goals have to do with why a particular investment is made. For instance, one designed to fund an education is going to have a different strategy than another for retirement. Finally, the taxes that an investment is subject to need to be considered. Now that we have that out of the way, let's talk about how your money can be used to make more money. There are several ways of doing this. These include savings, equity, and debt. We'll cover savings first. The area of savings encompasses savings accounts, money market accounts, and certificates of deposit, or CDs. These kinds of investments are available through commercial banks and, to one extent or another, through savings and loan institutions, as well as credit unions. Why don't we take a look at the strength of these kinds of investments? As far as risk and reward go, savings score really low. Although they present minimal risk to the investor, since they're federally insured up to $100,000, savings offer a fixed return. Now, $100,000 is nothing to sneeze at. So as far as investment size goes, you can see that there's quite a bit of flexibility. You can save a lot or a little. Okay, let's see how their liquidity measures up. Whoa! We are talking liquidity here. That's because things like money market and savings accounts generally have no penalties. And now, even CDs have low penalties if they're cashed in early. So how much attention is needed for savings? Well, let's just say you don't have to be a rocket scientist to invest this way. Savings are best suited for the short term, although many people use them for longer term needs. They can be part of any investment goal, but they're not perfect. And keep in mind, the interest payments they generate are taxable. All right, that's enough about savings. Remember, there are 3 other ways to use your money to make money. Let's examine the next one, providing loans. These kinds of investments have to do with corporate bonds, municipal bonds, government securities, and bond mutual funds. When deciding about bonds, keep in mind that their prices fall as interest rates go up. But when interest rates go down, the value of bonds increases. So exactly what is a bond? Well, it's a certificate that's similar to an IOU. It just says that somebody owes you money. When you acquire one, like this U.S. savings bond, you're buying a debt, and that makes you a lender. Bonds are a great way for public and private institutions of all kinds to borrow money. And because they're fairly predictable, as long as you hold them to maturity, bonds are a very popular way of investing. Right now, our studio audience is going to see how bonds measure up. First, let's consider the issue of risk and reward. As you can see by our meter, bonds rate average in this area. As with other types of investments, the potential reward varies with the level of risk. Now, one of the biggest things to remember about bonds is that they may not keep up with inflation. Remember, their value goes down as interest rates rise. Okay, now, how about investment size? Okay, just like with savings, when investing in bonds, as our scientifically calibrated meter indicates, you don't need a whole heck of a lot of money. You do need more of it, though, if you want to build a diversified portfolio. So, as far as investment size goes, a bond fund is a real option for the average person. This is a type of mutual fund, something we'll talk about in a minute. Now, let's see how their liquidity measures up. What do you say, audience? Our super duper meter shows bonds are fairly liquid. That means they're pretty easy to cash in. But there are potential drawbacks for selling a bond before its maturity date. For instance, one risk might involve selling it for less than what you paid for it. Now, it's really important to be aware of this since the life of a bond can range anywhere from 3 months to 3 decades. So keep this in mind when thinking about liquidity. Moving right along, how about if we rate bonds in terms of attention? What do you think out there, folks? Our audience's low applause means that bonds need very little attention. And that's good, since most of us have better things to do with our time than always be thinking about bonds. With some bonds, you need to periodically clip coupons that are attached to them, and then send these in to receive your interest payment. Pretty tough stuff, huh? Now just don't forget the stamp. Bonds are a great way to invest, if you know ahead of time when you'll need the money, like for a college education or retirement. And when it comes to the tax man, though, bonds are a mixed bag. The income from municipal bonds, for instance, is tax-free. The capital gains, however, are not. But the interest and capital gains from corporate bonds are taxable. Okay, so much for bonds. Let's talk stocks. Besides being a wonderful decorative item for the home or office, stocks are an excellent way of investing. When most of us hear the word stocks, a picture of Wall Street usually comes to mind. And when we think about how stocks are bought and sold, a lot of us think about places where traders are yelling and waving little pieces of paper. Although this still happens. The information age has brought us computerized trading. Actually, did you know that one of America's largest stock markets, NASDAQ, doesn't even have a trading floor? It's all done by computer. But none of this information will do you any good if you don't know what stocks are all about and how they can work for you. Stocks are issued by corporations. When you buy a share of stock, you become a part owner in that business. The more shares you own, the more influence you have in its operation through voting privileges. And the money you make, or lose, with your shares of stock depends on the corporation's success. The stocks generate income in 2 ways. The first is through regular dividends that are paid out to shareholders. The second way that stocks may make money for you is if the share price increases. These 2 factors help set growth stocks apart from income stocks. Growth stocks are ones that are bought in the hope that they'll quickly increase in value. Income stocks are those that are purchased based on the dividends they pay to shareholders. Now, there are a lot of terms that have to do with stocks. Book value per share, price-earnings ratio, return on equity, and stuff like that. To help you understand these things, you should find yourself a stockbroker. Now, that's a person who's licensed to trade stocks on 1 or more exchanges, and who will buy or sell stocks in your behalf for a commission. Because this is such an important relationship, be sure only to use a stockbroker who you're comfortable with. Now, that comes from asking questions like, how long have you been a stockbroker? What do you base investment decisions on? How many clients do you have? What are the names of 2 or 3 clients I can contact as references? Remember, the more questions you ask, the better off you'll be. With that said, let's look at the characteristics of stocks as an investment. In our first category, risk and reward. Stocks are right up there. Although more risky in the short term, historically they've done better than most other investments over a longer period. As far as the size of the investment goes, it can range anywhere from fairly small to pretty large. To have a good mix of stocks, this is called a well-diversified portfolio, you're going to need about $20,000 or $30,000. So, what about liquidity? Well, although you can sell stocks at any time, you should consider them as part of a long-term investment strategy. Keep in mind that, depending on market conditions when you sell, your stock may be worth more or less than its original cost. And don't plan on snoozing when you pick up shares of stock. That's because they require attention, since they react quickly to economic news and world events. If you've selected your stockbroker with care, you should feel comfortable talking about these kind of things. Stocks can be used for just about any kind of goal as long as they're given enough time to produce results. This means keeping them at least 5 to 10 years. That's a normal market cycle. You know, the buy low, sell high kind of thing. But you need to remember that while holding on to a share of stock, any dividends it generates are taxed. And if you later sell it at a profit, the money you make is subject to capital gains tax. If you'd like to invest in stocks, but don't think you're quite ready, think about the possibility of mutual funds. Mutual funds give investors access to a number of different opportunities. They offer individuals, as part of a large group, the professional expertise that's needed to manage diversified investments. In fact, mutual funds offer the kind of help that would otherwise cost a heck of a lot of money. They can encompass stocks, bonds, or just about any kind of legitimate investment. And many traits that mutual funds exhibit are ones geared toward the average investor. Let's go to the videotape. When it comes to the risk and reward of mutual funds, they're all over the map, from very low to very high. So, how about the size of the investment that's needed? Well, you can see on our scoreboard that mutual funds are geared for investments of many different sizes. Moving right along, let's look at the liquidity of mutual funds. Let's say mutual funds are pretty darn liquid. Most can be sold by just making a phone call to your broker. But when doing this, remember that like stocks, their value will vary up and down from the time that you bought it. And what kind of attention level do mutual funds need? As you can see, they require some attention, but not a lot. Mutual funds can be used to meet just about any financial goal, but mostly for long-term needs. And they are taxed, except for those dealing with tax-free bonds. That's a brief rundown about mutual funds. I bet you're wondering what I'm doing on this golf course. Well, just think of one word: retirement. A lot of us are going to live fairly long lives. That means the number of years we spend in retirement might really add up. So, all of us need to start planning for retirement right now. And guess what that means? You got it, investing. Now, the investments we've been talking about, stocks, bonds, savings, mutual funds, can all be used for retirement. To take advantage of tax deductions, there are a number of ways to package your investments. These include IRAs, Keogh accounts, SEPs, and 401ks. To find out what's available where you work, talk to your boss. And if you're self-employed, then check things out with your accountant. Hey, I know we've covered a lot of stuff here. Believe me, there's a lot more to know about all of the investments we've been talking about. And there are a lot of other investments out there. Some that are pretty risky, things like commodities futures, precious metals, and options definitely aren't for the beginner. Other risky investments, such as real estate or collectibles, could be part of your overall strategy. But it's real important that you start getting familiar with what's available out there, because you need money. And a good way to get it is by investing.